All right, guys, I'm back. I saw the question on the pivots. All right, don't get hung up on level 2, level 3, level 4. All right, we went through that to define them so that you can recognize different formations. The idea is if it's a level 2 or above, all right, and prices move above the prior high, that becomes your reference point of support. That's it. Okay? The thing is so that you just recognize that it's a pivot. If we don't define it, right, we don't have that definition, right, it becomes gray. Right? Once we have the definition, it isn't gray anymore. Right? It's just there. You don't make different decisions whether it's a 2 or a 3. All right? Decision is the same. All right? All I want you to do is recognize that there is some difference in the formations. That's all. You're not going to make one decision versus another because of that pivot. All right. Yeah, on the DVDs coder, just email me, greg@pristine.com, and I'll send you the information on how to set that up, and so I'll send you the files. You do need the data from Pinnacle Data. And so without the Pinnacle data, it doesn't work. It's not expensive, and if you call up Ed at Pinnacle and mention the DVDs, they'll give you a 25% discount on the data. Once you set it all up with the instructions that I'll send you, you just open up the pages and it'll work. Questions before we continue? Yeah, pinnacledata.com. There you go. I was talking. Can you guys hear me? I know Coder can hear me. Yeah. Okay. All right. I tell eMore log out and back in. I might just type something in the room. It took a long time. Okay. Okay. So any questions before we continue into the next section? You can hear now? Okay, great. All right, you guys are making it easy for me. All right, let's continue with gaps. I'm going to. All right, Luke. All right, and I'll give you the short version here before we start, and then we'll go into the longer explanation of it. Right? We're going to start with a daily chart, right, with a gap. We're going to look for buy and sell setups from the daily chart. Then we're going to look at the intraday chart and see how that formed. All right? So if it's a bullish bar, a bullish COG, or a bottoming tail, we're going to see how that formed inside. We're going to see whether it was basing at the end of the day or whether it was rallying at the end of the day. All right? bases are consolidation periods, resting periods, right? Put that in alignment with a buy setup. The stock isn't overbought. It gaps up. It should go higher. Now we just look at what happens in the morning after the gap. Does it pull back into the base to fill the gap? Will we get a changing of the guard and buy it? Does it 5-minute high, green bar? Do we buy it above the high, looking for a continuation move higher? Or does it possibly consolidate and we get a breakout pattern, right, on that day, where we're getting a break from a consolidation, which is starting from a pro gap up, right, and a daily buy setup, or vice versa. Daily sell setup, PSS, right, climactic sell setup, or it could be a gap from a gorilla type strategy. It doesn't make a difference, right? The idea is, how did the bar form inside when we look at the intraday charts? Is there a consolidation, or was it declining? Right, we look at the intraday pattern. Then we put the current day's trading in the context of that intraday chart, and then trade it accordingly with a bias in alignment with the daily chart. That's true, Bill, unless I guess something of great significance might happen in the middle of the day, you know, because it would be rare to get any kind of a gap in the middle of the day. You know, so gaps are seen at the beginning of the new day, as, you know, you have, you know, the overnight session, nothing's happening, and then, you know, the stocks open up the next morning. But for the most part, that's true. So there you have the whole gap section. All right, but let's go through it, and we'll look at examples. But that is the basis for our thinking or thought process when it comes to gaps. Right? So gaps are occurring in the morning, right? And we have gaps between bars, and we have gaps away from the current bar, right? Which leaves a void between one bar and the other, or there's inside gaps. So the prices are gapping from the prior day's closing price, but it's inside the prior day's range. Okay? So those are the two ways prices can gap, and then we'll look within the bars to see how those intraday patterns formed. Right? When we're looking at the gaps, we go through the analysis. Right? Say, well, what's the market doing? Right? Is it gapping with the stock? Are they gapping in the same direction? We can look at the sector as well. Right? Where are the futures gapping to? Right? So if they're gapping up, are they gapping up into resistance, or where there's going to be supply? Are they gapping down into demand? Okay? Take a look at your market internals in the morning. Right? Usually you're going to have to give them, 5, 10, 15 minutes. To give you information. But take note of where the trend is in the morning. And we start collecting data on the trend. If you're looking at a 5-minute chart of the trend, you want to start collecting data on that at 9:35. This way it doesn't get skewed by that first data that's coming through and mess up the chart. And we'll see which side of the trend the 20 MA is on, which way is it trending. If there's a significant gap in the trend in the morning, and that would occur typically with a larger gap up or a larger gap down, that's going to skew the relationship between the trend and the 20 MA. So at that point, if you got a gap up in the trend and it's above the 20 MA but declining, the fact that it's declining is what we're focused on, even though it's above the 20 MA. And with the same thing with the stock, right? When we say is it gapping in the direction of the 20 MA or against it, I say we're looking at where is this gap in relation to the existing trend on the 5-minute time frame. Then looking at the stock, is it gapping to support a resistance? Right? And the gap, is it a novice or professional gap? And so primarily what we're looking for are stocks that are gapping, right, from a novice type gap, right? I mean, I should say a professional type gap from a buy setup or a sell setup. Then with the, the 10-10 bars or 20-20 bars, those gorilla type things, it may or may not be a professional type gap. I guess it depends on how, the extent of which it's gapping and what the daily is set up. But as we look at those, our primary focus is how it formed intraday, right, within that bar, and then putting that in the context of the current day's trading. No, the trading in the direction on the 20 MA on the 5-minute chart doesn't necessarily say whether it's a pro gap or a novice gap. What we're looking at is its relationship based on the 5-minute time frame and putting that in the context of the daily. Right? The daily time frame is what would tell if it's a novice or pro gap. Right? Is it gapping, right, after a pullback and a reversal, or after being extended and gapping from that, versus prices having run up multiple bars in a row and then gapping higher from that on the daily chart. That's a novice gap, or a gap down after multiple bars moving lower. We use that to we're defining what the trend is on the 5 minutes. So if prices have formed a PBS and a changing of the guard, and it gaps up, it should be above the 20 MA, all right, on the 5-minute time frame. And same thing with a climactic buy setup, all right? If it's a sell setup, it should be below the 20 MA on the 5-minute chart. And the reversal bar, once that forms during the day, that will move prices above the 20 MA with a buy setup, on a daily buy setup. There should be enough congestion there to do that. We're going to start, right, with our buy setups, PBSs, right, climactic buy setups, or potent reversal bars. And it says, again, that assumes that prices are going to move up. And so if it should gap down by chance, we don't want it to a significant gap down. Right? Ideally, we're looking for a gap up, the gap up not to be, too extreme, right? But ideally a gap up or an area, or open in the area of the prior day's close. Right? If it gaps down too far, right, we might have a failed setup there, a failed buy setup. That would probably be gapping down under support, and then we would look for potential shorting setups. Right? So looking at the current daily charts of the indices, and we looked at the hourly charts, and we have a base there. Right? If prices were to gap down, I told you we'd be looking for shorts. Right? On the other hand, we've got a bullish COG on the daily charts, and if it was to gap up, then we're going to look for longs. Now we look at, once we start with the daily, then we look at how it formed in intraday. Right? And same thing with the sell setups. Right? We're going to look for PSSs, climactic sell setups, or potent bearish reversals. Looking for a move lower, and if it gaps up, right, it shouldn't be a significant gap up. Right? If it gaps up too much, right, we would have a failed setup, right, which then would suggest to us to reconsider, the sell side and look at the long side. Right? Same thing, look at the intraday patterns, right, and we'll do this for 10-10 bars as well. Right? We look at how that formed intraday, and then that'll form our strategy as to how we're going to play that gap. These next slides are going to be the setups that we're going to be looking for. With a smaller gap that pulls back into the gap being filled, we might see that on a 2-minute chart. And if we see that changing of the guard into the gap fill on a 2-minute chart, right, we'll take that as a long trade. They could. This is the way, Bill, that I would trade the gorilla plays, right? In the exact same way. Rather than trade them and hold on to them based on the daily chart and hold them overnight, I use those strategies or tactics on formulating trades from an intraday basis. All right, so if you were looking at a gap surprise or a mortgage or whatever, right, and you get the gap, you're going to go through the same process. Right? What does that gap suggest? Look at the intraday charts, and then look for the setups. The 30-minute left. Five-minute is 3, 4, 5. The idea here, Coder, with the 30-minute, the idea here, first of all, don't get so hung up on it being 30 minutes. Right? Sometimes prices are going to break out of a consolidation after 20 minutes. The concept here is not to be shorting 30-minute lows after a greater than 100% retracement. You want a consolidation from a base. Right? What we don't want to do, right? And I'll just draw it on here and say if you had prices moving up and then moving down, and then you're shorting with a setup like that, right? That's not what we want to do. What we look for in a scenario like that is once it breaks the low, we're looking for this. We look for retracement and then down. I'm a little slow on that one, Bill. What is RTs? Reversal times. It would most likely, with example 1 on the 5-minute chart, right? Aligning this up with reversal times definitely does happen. We saw that happen on Friday, right? Where prices pulled back into reversal period. All right, hold on. All right, there's the cues. You got to pull back into a consolidation. It was right at 950. You got the bottoming tail bar. That's correct, Luke. Yep. There you go. So, again, going back to the current daily setup, we've got a bullish COG, or we can use the gorilla type strategies. But again, we're going to go back and look at how that formed intraday and whether there's support there. Right? What is the reason why this should turn around? As as we're going to trade this gap. And so if we got relatively small gaps and we get a pullback, right, we can trade it off at a 2-minute chart. And if it's a larger one, right, you're going to 5-minute chart into a reversal time. What example 1 is showing you is that with either of these, the bar on the higher time frame is going to be a red bar, which is okay, right, because we're in an area of support, and this is looking for the transition. Right? We're getting in on the transition from the red bar into the green bar in anticipation that it's going to move up based on our analysis from the daily time frame. Example number 2, right, is one in which the first 5-minute bar, right, closed above its opening price. Right? So we've got a daily buy setup. Ideally, and we'll look at this in a minute, it was consolidating at the end of the day. That's what we would want. Right? So which means the stock isn't extended. And then you get a strong close, the first 5-minute bar, and you buy it above the high of that bar. Okay? And the same thing with sell setups. Daily sell setup, consolidation, right, into the close, a gap down, shorted under the first 5-minute bar's low. Right? I explained to you the 30 minutes. We want consolidation prior to the breakdown or the breakout. Right? So we've got a base, not a break of a prior low after it retraced more than 100%. Those aren't the only setups we can trade. Different days set up in different ways. Okay? So, daily buy setup, you can use 5-minute PBSs. And so, maybe you don't want to take it over the first 5-minute bar's high. Right? You don't trade first after the first 5 minutes. That might be part of your plan. So you're getting a pullback, right, toward the low of the day, and you get a PBS, a chaining of the guard. And again, our bias is based on the daily, so you buy it there. Right? Sell setup, right? You can get a retracement back up and to short it from that point. Okay? I say these can be more than 100% retracement at times, meaning if it takes out the low of the day, it's okay to still buy it. An example of the buy setup. Remember, our bias is based on the daily. And again, we're going to look at how this looks intraday. But this would be our entry point, right? Even if it took out the low of the day. Failed PBSs. We have to have a daily PSS or climactic sell setup. So we're anticipating that the buy setup fails because it's happening against the daily time frame. And it should be a void below, right? Because the daily is a sell setup, and we're getting a failed PBS. Right? The sell setup has occurred after several days up, and a reversal. There should be a void below for it to drop into. Failed PSSs for daily buy setups. Our next slide here has different examples, right, for us to focus on. Q's gap. But they have sold the Q's gap. You mean shorted it when it gapped up? No. No, because I wouldn't have shorted it because it's gapping up. And just looking at the Qs there, it would be difficult for me to do it just looking at the Qs. Now, if we were looking at the E-minis, and I look at how that was trading first thing in the morning, I might have formulated a strategy based on that, because it's trading pre-market, and I can see the trend at that time. And we could take a look at that. It is pretty whippy and erratic. I don't see any clear setups looking at the 1 minute chart. Hold on. Let me put an arrow on there so you can see where the open is. That's what it looked like on the 5 minute chart. It was in a downtrend, but it whipped down so fast at that time. The risk to reward just would not have been there to get in at that time. You know, it was too close to the prior low. It wasn't a good setup for me anyway. All right, so on our slide here, I got various setups. It's a good slide to print out as a reference for your setups for bullish patterns, bullish daily patterns, and looking for intraday patterns. Right? And we've got retest patterns on here as well. You know, your W bottom, right? Things set up in different ways on different days. All right. So here's the idea when we look at the changing of the guards. When we look at the daily chart, is to look inside of that bar, because the bars on the daily chart, right, can look virtually the same and give the impression that they're going to react in the same way, and that isn't the case. So when we look inside the bar, we want to, if we're seeing a red bar, I want to see what happened toward the end of the day. Basically, I want to see where the support is, where the significant support is, or the resistance, and then put that in the context of the gap. So, as it says here, this one on the left is going to be a better gap and snap type of a pattern. Whereas if it gaps down, right, it's already been falling all afternoon. So a gap down from a bar like this is going to have greater odds of retracing back up again. And if you want to trade the gorilla strategy, right, where if it comes back up into the high, it would make more sense because there's very little overhead resistance. Whereas the one on the right has much more resistance because it consolidated for the majority of the day. Now, on the other hand, if you were to get a gap up from a pattern like this, right, and you say, well, here's a surprise type pattern, a gap up and go from a pattern like this, right, would be better looking for prices to continue to move higher. Right? Because if traders are selling, right, prices are gapping up. And now when you get the gap up, you want to see where it's gapping up to. Right? So if it gaps up above the top of this consolidation, right, well, pullbacks into that consolidation will be bought. Right? If the first 5 minute bar was to close up near the high, that is going to be a higher odds pattern, right, to continue to move higher because it's gapping above a consolidation, versus a gap up in a 5 minute bar with the one on the left, right? That's going to be one where potentially, right, it might take out the high and then come back in again. right? Because there's very little support here, right? And it might be gapping up closer to the resistance. When we look at bullish bars, we'll do the same thing. Okay? The daily bars might look exactly the same or very close to being the same, but we want to look inside that bar and see whether it was rallying into the close, right, moving higher, or whether it was consolidating. Okay? A gap up from the one on the right, right, with a green bar, right, the first 5-minute green bar closing above its opening price is going to be a much higher odds trade of taking out the high of that green bar and moving higher versus the one on the left. It's already been going up for a couple of hours, right? So a gap up and a green bar from the one on the left is more likely to fail. Excuse me one second, guys. Okay, so you're getting the idea here, right? We get our setups on the daily, then we go to the intraday charts, right, and see what the likelihood is of continuation or failure. Right? So a gap down from this bar, right, is more likely to produce a move lower, right? Because now traders are getting caught. Right? They're getting caught here. They had anticipated that it was going to move higher as it was basing into the close with a bullish bar. Right? So now all of these traders are caught and holding losses. And so we got a gap down and it rallied into this congestion and we got a PSS during the first reversal period. Right? Well, that would be a good setup looking for lower prices. If it gapped up, right? And you got the first 5-minute bar that closed red and it dropped down into this congestion and you got a bullish COG, well, that would be a good setup to go long and look for prices to go higher. Right? So again, daily chart, what's your bias based on that? Look at how it formed intraday, right? Then see how it sets up in the morning. The idea is the same with bottoming tail bars. Okay? So whether it's a COG, a 10-10 bar, bottoming tail bar, topping tail bar, we're going to do exactly the same thing. Right? Look at how it's set up intraday. Right? If the bottoming tail bar here is saying it's going to go higher, well, it's already been moving higher into the close. It's already extended from an intraday trading point of view. Right? From a swing trading point of view, we don't care about this because you're going to give it a big enough stop. Right? But from an intraday trading point of view and looking for the gap, we have to be concerned on how this forms. Right? And a bottoming tail bar with a consolidation. Right? It's not extended. It can keep going. Topping tails. Was it dropping into the close? Was it basing into the close? Okay. Gap down from the one on the right. The first 5-minute bar closes red. Go ahead and do it. Gaps down. First 5-minute bar closes green, and it rallies up into the congestion. You look for the sell setup for it to roll back over again. Right, on our next slides, what this is displaying is what the daily chart looked like, right, inside the blue box. Right? That blue box is our daily chart. Okay? And what we're focused on here, right, is at the second bar, the second candle here. Right? We're viewing what happened at the end of the day. on that bar. This is the end of the day on the second candle. All right, and the open it says open. The red slash line is the open here, right, on the new trading day. Right, you can see the slash line here. That separates the new day, going into the new day. Right, we're not viewing what happened in the morning on the second candle, right? And you can't see the intraday from the bottoming tail. And it's just you get the idea of what the daily chart looked like and how it was setting up, right? And in this example, it gapped up. It gapped up from a 10-10 bar. Right? The daily had gapped down the prior day, and then it rallied up toward the close, right? And then it gapped higher the next day. So our daily chart suggests that prices should move higher. So that's our bias based on the daily. We're looking for a setup based on that bias. So we had an end of day base, which means that prices rallied in the morning. You can see the gap down that occurred on the green bar here. Right? So it rallied in the morning, and then it went sideways into the close. Then it gapped up right at the open, and then it pulled back into the base where we get a buy setup, and our entry is going to be above these highs right here. Right? Note the bottoming tail bar. What is it about that bottoming tail bar that I like that I showed you guys? Yeah, but what happens with that bar? Right, all right, it takes out the low. All right, we want to see that correction that takes out the low. Right, it's a shakeout. Exactly. All right, that is what's going to help this thing move up without really the wiggles. Yeah, it could hit stops. It's taken out the sellers. Yep. So that would be our entry point when it takes out that high of the bottoming tail bar. And we're doing that in an area of support. Right? Now our next one, right? We've got a 10-10 bar. Right? Prices had rallied in the morning, and they consolidated throughout the afternoon and rallied into the close. Right? And then we get a significant gap down, and it gaps down under the consolidation. Right? So this would be your gorilla type strategy, right? Whereas as I look inside the bar, now it makes more sense why I would want to short this, even though it's gapped down, and we say, you know, bulls have gotten caught here. I can look at this pattern and say, wow, look at how bullish they were buying it right into the close. Look at the volume right into the close there as it moved up. And now it gaps down under a base. Right? All of these people are now holding losses. Yes, right, Trip. And should it gap down under that base? Right? I don't know about pro gap, Bill. I wouldn't even get hung up on the term. I guess you could say it's a pro gap. I would view it more as a shock, right? So who's ever forming that base there, you know, it's just this has shocked everybody because this just set up the totally unexpected. The pattern did not suggest in any way that it would gap down. So now you've got all this supply overhead to drive prices lower. So the first 5-minute bar is a topping tail bar, closes below its opening price. Right? So we short it under the low. There's a void below, right? And then let it do its thing. See what happens from there. bottoming tail bars on the daily chart. It was basing at the end of the day, and then it gaps up from there, and it begins going sideways. Right, so initially, after the first 5-minute bar, right, we'd be thinking lower prices into the gap fill. Right? And then it doesn't follow through. Right? We get another red bar. It doesn't follow through. And then we get a green bar. Right? We have to buy it above the highs. Right? It's not dropping. We can see that. Right? And that's where the bar by bar analysis is going to guide you. It's not dropping. You know, and by watching the action at that time and focusing on that stock, you're going to get a feel for what's going on there. You know, so when it breaks out, you're going to have been watching this stock and seeing how it wouldn't drop. Right? You see that there was strong demand there at that time. Right? So you take it and then, you know, start trailing. You know, see how far it'll go up, see where resistance is at, and so on. Just, right, you know. Well, that would be the strategy, Bill. You know, a 30-minute high, but the point here is that look where the 30-minute high is. Right, the bars said it's going to go now. You know, after 20 minutes, the 30-minute high is going to be up here. Right, so well, the 30-minute high is a guide. It doesn't necessarily going to work out to be 30 minutes. Right, if you see this stock gap up and it won't go down, you know, the market's starting to rally, this thing's starting to move up, it's time to buy. Right? By the time 30 minutes go by, it's already on the way, and at that point, you're going to be thinking, you know, I'm going to have to wait for a pullback, and in this case, it never happened. Right? So the time to buy was here. No, it's not a novice gap. Right? Again, all of these examples, I said we're starting with a daily chart that suggests that prices should move up. Right? And look at the 5-minute chart here. Right? This was not moving up, you know, all afternoon. Right? That's why we're looking how this looks intraday. Right? This was basing all afternoon. Right? Look at the moving averages. Right? They're close together. Right? This was going through a consolidation. Right? This pulled back. Look at the slope of the 20 MA over here. Prices were pulling back over the last several days. Right? The 20 MA was declining and then it flattened out and then turned back up again. Right? The 20 was above the 200. So even without looking at the daily chart, looking at the relationship of these moving averages, you can see that this was correcting from an upward move. Luke, are you saying over here? So yes, because this corrected. The red bar took out the low. Right. The next thing to check is make sure that there's a void. How much resistance is, you know, where is resistance in relation to this happening? And as long as you have room to run higher, then it's fine to add based on that. No, reversal time wouldn't keep me out at all. Reversal time sometimes results in continuation time. This is what we're looking for. Similar, you know, it can form in different ways, but again, the idea here is with a breakout above a 30-minute high, you want to see some consolidation before the breakout, right? Versus having moved down and then moving straight up to take out the high. And so we had a consolidation here. It was a gap up, right, from a base. So although you have a big bar here on the daily, you've got a large bar, right? The fact is it's not overbought, right? So while you wouldn't look at this daily chart here as a swing trade entry, right? It's okay to trade it intraday as a gap trade, right? Even though it's gapping up after being up, considerably, right? On this green, you can see on the 2020 bar, and it's gapping up from that. It wasn't rallying into the close, right? It was basing all afternoon, right? So prices do go higher multiple days in a row, right? Just because you didn't catch the turn for a swing doesn't mean you can't trade it intraday, right? Strong stocks typically continue to move higher, right? And they can do that a lot of days in a row, right? So look at how it formed intraday, and then formulate a strategy. Gap and go would be like a gap up from a base like this, and taking it above the first 5-minute bars high. It would be, we looked at an example of a gap and go type of situation here. Right, with this, right, where you're getting in after the first 5-minute bar, right, at a gap down under the base. And so again, you're formulating your strategies based on the daily chart, intraday chart, the setup that happens, right, in the morning. Now, on this slide, we're looking at an alternate entry because the gap down here, while it was significant, right, you're getting that shock, right, it was rallying into the close. So there's a void up above here. And so the first 5-minute low, that would be a more aggressive entry, because you've got that void above, right? These potentially going to have, you might get wiggled out of this where it moves back up again. So an alternate entry in this type of situation is going to be more conservative. You may not get the alternate entry, but here, we're showing you that, it broke down and then it consolidated. We look at this bar by bar, right, topping tails, and it begins to break, and that gives us our alternate entry point, looking for a move down. Here's a gap and crap. Here's a gap and crap, and this is what you'd want to look for. You got 2 big up days, and it gaps higher. Right? We're looking for that novice type of gap. Well, here's your entry, right, from an intraday trading point of view, right, where it breaks down under these lows after a breakout failure. And this example stopped right in the gap, and it began to hold. So, as an intraday trader, you'd have been out of this down here. As the guerrilla trading strategy, you'd have been holding on to this throughout the day, and then would have, ridden this down. Up and go was reverse GNC. And guys, don't get, as far as guerrilla strategies go, just think about this from how I'm explaining it to you. Right? Look at the daily setup. See which way it gaps. See how it formed intraday and form your strategy like that. Right? If it's going to gap up and keep going, right? The ideal situation would be end of day base, it gaps up, and you find an entry for it to keep going. Breakout failure. Yes, you enter below the breakout failure bar. And our daily chart was pulling back, and we get a gap up from an end of day decline. First 5-minute bar closes green, right? It closes near the high, right? So your entry's above that first 5-minute bar, okay? Looking for a move higher. Okay? If it was a red bar, could have got to move down into a gap fill, looking for a buy setup, a bullish COG, possibly at 950, 1010, and then it might have gone higher. And once we have the setup and daily setup, intraday, how that is structured, and then we look at how it sets up first thing in the morning. This example of loose supply here, right? Pivot highs and lows. Right? So when you have loose supply, right, odds are prices can push up through it more easily. Okay? I like the light bulbs. Right? Bullish pattern. Right? Bullish 10-10 bar, slight gap down. Right? You got resistance up here. Right? Now buying above that first 5-minute bar is high, with the gap fill just above is going to be lower odds. Right? So here's an alternate setup where it pulled back into the first reversal period, and we got a bullish COG, and we buy above the high of the PBS. Right? Obviously, we have to watch how it's going to react to the high of the day here. Right? Figuring that there are going to be sellers up there, but based on the daily chart and the setup that's happening, we're taking the trade and then waiting to see if it can push through it. Whippiness would be another way of saying loose supply, Coder. In that what we want to make sure, though, is that that whippiness is not just a bunch of overlapping bars side by side. Right? It's pivot highs and pivot lows. Right? It's moving up and it's moving down. Right? In other words, it's got like holes in that resistance. Yeah. It's based on the bias of the daily chart. Right? Our daily chart's been moving down. Remember, I'm not showing you all the patterns, but the assumption is that this daily chart is either a PBS or a CBS. Right? So a gap up from that is a pro gap. That's why you would take this long, even though it's not an end of day base. Right? Again, the ideal scenario would be for that to be the case, but here, this is a different example. Right? But again, it's based on what's happened on the daily chart. This next slide, It's a bit different, but again, we're not always going to get exactly what we've been looking at, and that's why it's here, right? To get the idea that as I look at this daily setup that says prices are at a turning point, right? This intraday chart had retested the prior low, and it gapped up above this congestion, which now makes it support, and it pulled back into that area, and there is one of our favorite bars. All right, there's one of our favorite bottoming tail bars right there. That breaks those prior bars lows, right, and rallies back up. Right? And again, it doesn't have to be a green bar. You just want to make sure that the body is up at the top of the range of that bottoming tail bar. All right? You can take it above the high of the bottoming tail bar. So our strategies here, right, that we're setting up, looking at for our gap strategies, you're going to be out of these trades, right? Most likely within a half hour or less, okay? You know, by that amount of time, if you're in, you should either be out or enough information to, you know, gotten a profit or confirmed your, your entry point. You know, most of the setups that we're going to look at, you're going to know within 10 minutes, right, if it's going your way. Right? You're going to look bar by bar analysis, look at what the futures are doing, right? You time what's happening in the market with these setups as well. That's going to add, you know, to it working out. Right? Now, as I said, the last point: start with your daily setup, and then look at how it formed intraday to formulate your bias, and then see how it sets up that morning. It's pretty simple, isn't it? I mean, what I explained to you before we started, and then we looked at the examples, right? Is that we get our bias from the daily chart, we see it how it looks intraday, right? And then we look how it sets up, right, in the morning, right? Just if something